Hey Steve, I didn't know you were here today.
Hey Sean, nice to see you.
Yeah, good to see you actually, because I was going to ask you something. My daughter and her schoolmates are looking to go to the aquarium.
Sounds nice.
And they're selling chocolate bars. So
Okay.
I was wondering if you'd be willing to maybe, chalk up a few for some choco.
Well, sounds like a good cause.
Yeah?
I could look at chocolate bar. What are they selling for?
$5 a pop.
How much money are they trying to raise?
Well, $1,000.
$1,000. So that's what, 200 bars? 200. Can I do my math? Yeah, 200 bars.
Yeah?
Well, tell you what, maybe we could do, I'd take $800 and I could buy them all for $4 a piece. How about that? Take them all off your hands.
Done deal.
Well, it's like a bought deal on Bay Street.
Oh, is it?
Yeah.
Boy, what's a bot deal?
Well, bought deal is when a brokerage firm takes the whole issue from an issuer, buys all the stock or all the bonds in one shot, does it at an appropriately discounted price, builds their fees in, and then distributes it almost immediately or overnight to all their clients. It's a Canadian invention. The Americans haven't done it historically. They've been
Really?
getting into it a little bit. But in fact, the Americans thought the Canadians were crazy. It came out of Bay Street in the late 1980s. Gordon Capital was one of the real innovators in that, and then the banks picked it up because the banks have all the muscle and they use their balance sheet. But the Americans could never figure out that the Canadian brokerage firms would actually buy the whole issue, and we're talking hundreds of millions of dollars.
Is there any risk in that?
Well, there is, but the risk is really a 1 to 2 day risk, and often the brokerage firms will have a good indication in their minds about where they might place the stock and what the price point is, but it's actually the least disruptive to the markets themselves.
Oh, really?
When you think of a traditional U.S. raise, which is still very much in place, a company announces that they want to raise maybe $500 million in the U.S., stock's publicly traded, and it's going to take 6 weeks to raise the money. They're going to do a 15 or 10 city roadshow across the United States, maybe into Europe. Well, that's very disruptive to markets. It takes a long time. The market knows there's new treasury stock coming, so the buyers back off, there's sellers, traders sell, and it can actually lead to a far greater decline in the share price than something that is done bang overnight. So the bought deals as a Canadian innovation, and Gordon Capital was able to, they were eventually bought by HSBC, but they were an innovative firm, and they could use their balance sheet and they would buy business. And of course, people initially thought, well, that's kind of risky to buy all that. But they did it more and more, and then eventually it became fairly much the norm.
Yeah.
In fact,
So why aren't they doing it in the States?
well, it is coming into the States now. I don't know to what degree, but it was just trends take a while to.
I mean, they're usually risk takers, or like to be known as risk takers.
But also, there are some differentials in terms of securities regulation. It's by no means restricted in the States, but what it requires is what's called in Canada a POP issue, or a prospectus, to be written already in advance and constantly on file. It's kind of like getting your mortgage approved before you bid for a house. So having a prospectus on file with the Securities Commission means that you could go out as a publicly traded company, an issuer, and issue shares at any time because you've already done the pre-approval, meaning the paperwork in this case. Same thing as going to bid for a house and you know that you've got your financing lined up. So it's similar in that respect, and it keeps the door open whenever conditions are favorable. But it's really, it's the least disruptive to the stock. It also means there's a discount, so buyers like it because there is a discount involved. Yeah. In my example, for your chocolate bars, I propose a 20% discount, but
I don't see why.
Well, I'm trying to make it easy for you. And then I'll
Sounds like
resell
you're
them.
trying to make it easier for yourself.
Oh my goodness. I don't, do I really need all those chocolate bars?
Well, that's the risk.
I suppose.
And the only place it's going to be disruptive is maybe in your belly.
There you go. That's true.
But hey, man, I really appreciate you picking those up.
Yeah.
And don't eat too many in the same day.
No, I won't.
All right,
I'll
thanks,
make
man.
sure they go to a good home.
Okay.